Meantime, the market's getting a boost today on reports that trade negotiations between China and the United States may conclude soon. This coming on the heels of a disappointing U.S. Manufacturing report, which I just mentioned. Its PMI dropping to that 18-month low in February. Our next guest says that for markets to be able to move higher from here, these 7 macro ifs must happen. Here with me, Seven's Report Research founder Tom Essaye. Tom, I hate to play the what if game because it can go on forever. That's what my mom used to say to me. But let's talk about what these ifs are, and the first one, the highest ranked in your eyes.
Sure. So, and my illustration with this, and Jackie, thank you very much for having me on. The point of this is to illustrate to everybody, look, we're off to a great start in 2019. But a lot has been priced in. So the biggest if right now is if the Fed doesn't hike rates again. Now, everybody assumes they're not going to in 2019, but what if the economy recovers? What if inflation gets above 2%? Then we have a little bit of a problem on our hands.
Yeah, that's certainly true. But that's not the only thing that you're looking at in terms of driving the market. What about the balance sheet reduction?
Sure, exactly. So another if is what if the Fed cuts its balance sheet reduction by 2019. Now, Powell has said he's going to do that, but again, we're assuming that this is going to happen because growth is going to remain slow. What if it turns around? And then we have an additional Fed-related if, which is if the Fed increases its inflation target. This is a longer-term issue, but it's very dovish. Point being, people have assumed the Fed has turned really, really, really dovish, but what if that changes if growth is better?
Okay, so just to put this in context, we went through 3 of your ifs already. A little bit less than half here rely on Jerome Powell. That's a lot of responsibility on his back. But also watching China very closely.
Yes, definitely. So 2 ifs regarding China. Number 1, if Chinese growth stabilizes. Everybody kind of assumes it's going to with the S&P 500 at 2,800 because they're saying, oh, there's so much stimulus in the pipeline. Well, okay, great. But this week we got another disappointing Chinese economic data point. So that needs to stabilize, number 1. And then regarding U.S.-China trade, we all know there's going to be a deal. But it needs to be a deal that sees tariffs rescinded. So if tariffs are going to be fully rescinded, then stocks can go higher. Those 2 ifs have to do with China.
Okay. Also looking at just global economic conditions.
Absolutely. Global economic conditions as well. Again, at 2,800 in the S&P, a lot of a rebound in global growth has already been priced in. So we need to see global growth rebound and U.S. growth stabilize. So again, stocks can rally if we see a stabilization in U.S. data, which incidentally, as you just said in the last segment, we did not see today via the ISM PMIs.
Okay, final point. You're looking at full year S&P 500 EPS estimates.
That's right. So we have to remember the correction, the October to January correction happened because of economic data, the Fed, and earnings. It was earnings that were the initial catalyst that caused that correction. Earnings have declined. Current consensus, Bloomberg consensus, about 172.50. If that number keeps falling, this market is in trouble.
Okay, and these are the 7 ifs we need to see. Again, just to reiterate, to see this market move forward and move higher this year. My question to you, if there was one that you had to pick that we just went through that you think is the riskiest, the one that is the least likely to happen, which would it be?
It'd be the earnings. The earnings, I think, are a concern. We have to remember, last year we got the big corporate tax cut in earnings, so earnings growth popped big time. Well, we're obviously late in the economic cycle. If we see that earnings number continue to be reduced, honestly, it doesn't really matter a lot of the other stuff. This market will have a very hard time rallying from here.
But what about the Fed? Because even if that weren't to happen, it's like investors always make excuses for different parts of the thesis that isn't necessarily working. But as long as, for example, the Fed doesn't hike again, that balance sheet unwind remains as promised, that investors will pretty much be happy with this market, especially like you said, if we get a strong jobs report and that kind of, sentiment is out there.
Sure, and I think that that's a fair point, but I'll just remind everybody that the last several large market downturns have happened when the Fed made pauses, right? So usually the Fed stops hiking rates because economic growth is slowing. if the Fed is once again now paused because growth is slowing. So the big question is this just a pause that refreshes, or have they hiked too much, and is the economy already losing momentum, and are we starting to, at the peak of the hill, starting to go down the hill?
That's a great point. Tom, Essaye, thank you so much for taking your time with us today.